is I would argue that retail has beaten institutional to this space already. That retail already understands the crypto markets far better than any institutional players understand them at this point.
Alrighty, everybody, what is going on? Welcome back to another CYPRX video breakdown. This is going to be part 2 of today's video breakdown. If you are watching this first portion, pause this one. Make sure that you go back and watch the first part of today's video breakdown, so that way you are in the loop with what we discussed in the first half. We listened to Franklin Templeton's Sandy Kual, who also has active participation in other large organizations like the World Economic Forum, the CFTC, and the DTCC, where she went on to say in the first portion of today's video breakdown that
so this is just an incredibly important, I think, tipping point moment for where we are. If you think about it, Tony, the financial market infrastructure that the entire global set of capital markets and payment rails run on was really devised back in the 70s. It came after the paper crisis in the 60s. They looked at the brand new emerging technology of the time, which was computers, and they redesigned the system. They immobilized and they dematerialized securities. They put into place these very important clearing processes where you had clearing organizations acting as the buyer to sell every seller and seller to every buyer, to centralize that function. And they came up with this whole approach of book order entry, where you settled firm to firm and then each firm had their own client records. And this has been the way we've run the financial ecosystem for the last 50 years plus. What we're seeing now is the first time that the next 50 years infrastructure is starting to come into focus. And we're really beginning the transition and we're beginning the migration. And it's not going to happen in 1 year or 2 years, but it's going to happen much more quickly, I think, than people anticipate. And it's going to feature the decentralization of the system we just centralized.
we are on the tipping point of global financial transformation, where over the next 50 years, we are really going to start to see a massive amount of traditional finance move over into this new decentralized financial infrastructure. And she believes that this is going to really start to pick up pace over the next 3 to 5 years, and you do not want to get caught playing catch up. With that being said, this is where we're going to dive into the second portion of today's video breakdown, where we're going to get into the opportunistic side of things and humbling yourself and coming back down to reality, especially making sure that you're not getting distracted by the mainstream influencer hype that's constantly pumping out price predictions to you guys, tapping into that over-exhausted dopamine hit fix content, right? And instead, you guys really need to be learning about the macro, making sure that you're doing deep dive research on your own behalf on projects that you personally find interest in, and not getting distracted by all of the bullcrap that is going to get you wrecked in this space between now and 2030. So I said here, more people are waking up to the game. The system was never built for your freedom. It was built for your compliance. But now the veil is lifting, and the real flex is taking your power back. Now that starts with self-love, belief reprogramming, and rejecting the idea that you have to stay stuck where you started. This is a wake-up call. You don't attract wealth with hope. You attract wealth with alignment. Everyone talks about being a millionaire, but most haven't even built the mindset to manage over $1 million. At CYPRX, we help you develop the inner foundation to handle abundance when it arrives. Reclaim your will, elevate your mind, and build from the now. And this just goes hand in hand with something that Franklin Templeton Sandy Kual said at the end of this video breakdown, keeping in mind that in the first portion of today's video, she cleared the air when saying that this is not a space for just crypto bros. This is a space for everyone to learn and grow and understand this massive digital transformation. But listen to what she says at the end of this podcast, where she goes on to confirm.
Learn, right? I mean, I didn't know anything. You didn't know anything. No one coming from traditional finance knew anything about this infrastructure or this ecosystem or how it operates until they started learning, right? And so learn, right? We in financial services, I think, are the most adaptable industry I've ever seen, right? There is never a challenge that we haven't risen to in terms of being able to digest and understand the opportunity and isolate it and rebuild to capture it and rebuild our businesses around it. So I think that this is just one of those moments where you need to challenge yourself to stop being a skeptic and take a step back and understand that this is a tech-driven change. It is all happening because there are new technologies that operate in new ways. And every time we've seen that, we've seen massive changes in how firms architect themselves and deliver their products and services. And we're just on the verge of yet another iteration.
Right. So she reiterated the idea behind learning this new technology, learning what drives markets, right? Especially right now in this headline driven environment, which we'll get into in this portion of today's video breakdown. You should be learning about macro fundamentals. You should be learning about geopolitical headlines and tariff implications and how central bank policy positioning and Fed speakers can sway different market sentiments intraday that create opportunities for you guys to get in at discounted opportunities instead of chasing retail driven pump when the market's pumping hundreds of billions of dollars, getting caught in tops, and then immediately seeing drawdown in your portfolio because you did not learn how to properly dollar cost average into this market to see a rising equity curve in your portfolio, not years from now, but in the now, right? In the short term, how can you make money? How can you position yourself every day in these markets or throughout the week so that way you can make money in the now? And not a lot of people are doing that. They're just aimlessly putting money into this market, hoping for some speculative price appreciation bull market cycle, and they're not actually building a skill set. They're not actually understanding the markets in which they operate in, which is where we separate ourselves here at CYPRX. So I want to capitalize on something that she said here before we get into the fundamental aspect of things. Is she confirmed that financial institutions are interested in this technological transformation. And so I want to take your attention over here to this Apollo investment thesis report. Now, Apollo, for those of you guys who don't know, is a huge asset manager in the space with over, I believe, 500, if I'm not mistaken, $700 billion of assets under management. So they are not one to play around with. And I said here in this post, institutions are no longer on the sidelines. This Apollo report shows that we are only in the first innings of greater institutional adoption. With firm conviction to build this industry into the future, the categories leading this revolution are stablecoins, asset tokenization, DeFi, and smart contract platforms, and they have already proven their staying power. So if you're not learning about these things, just like Franklin Templeton Sandy Call said, then you should be, which is exactly why we built the Wealth 28 Club platform, so that way you guys can see hands-on video-related material of us going through these things step by step, especially DeFi protocols, how to connect the wallet, how to turn idle digital assets that just sit dormant in your cold storage wallets into yield generation productive assets, right? What smart contracts are, what the risk exposure is in smart contract platforms, and all of those things. Now's the time to learn. So I said here to continue, despite the noise, crypto has crossed the chasm and entered an early mainstream adoption phase. Yet you need to remember that it's still early. Trillions in pension funds and institutional capital still remains locked out simply because the committees don't yet understand the infrastructure. That means the runway for growth is massive. And we've heard video clips of Sandy Call and previous video breakdowns say that retail has had the upper hand over institutions.
I would argue that retail has beaten institutional to this space already. That retail already understands the crypto markets far better than any institutional players understand them at this point. And that the capabilities and the functionality that the institutional financial services markets are going to need to develop are all coming now from the retail side. The gamification, the social interaction, the inclusion of short form video as forms of instruction, the ability to take actions on one's own that equate to what institutional players can do today, the ability to transfer assets peer to peer. These are all activities that retail are used to, and they operate with day to day in their everyday life. It's our institutional industry and it's our institutional rails that have kept us from keeping up with that level of innovation.
History reminds us in the year 2000, many pundits dismissed the internet as a passing fad. Today, the Mag 7 tech giants are worth more than the GDP of entire nations. The same skepticism still surrounds crypto today, but the valuation frameworks are evolving from daily transactions and gas metrics to deeper models combining on-chain data with traditional finance. So in this document, it mentions how Apollo's thesis is clear. Those who put in the research now who understand the architecture and the long-term value of blue chip assets will be the ones positioned when institutional walls break open. So now is not the time to wait. Now is the time to lock in. And so that's going to lead me over here to this, I personally think, phenomenal post from Eric Trump where he said, buy the dip. It's just crazy to me. And this is, by the way, on August 16th, 2025. It's crazy to me that we're seeing politicians come out and openly boost engagement and excitement around crypto. This is happening for the first time ever, where the largest political campaign supporting the crypto ecosystem is taking place. And we have never seen a bull market cycle in this type of environment. I cannot stress enough, ladies and gentlemen, that we are most likely on the precipice of an extended bull market cycle where so many people still think that everything that has happened over the past 16 years in crypto is going to mirror or reflect itself in the coming 5 years. And I feel bad for those types of people because, again, they're not doing enough research to really understand the current market landscape and the future trajectory of where this landscape could really head. Now, that's going to lead me over here since Eric Trump mentioned buy the dip. Do you even know why crypto shed over the past week over $260 billion of value? So I said here, let's be honest. Most people don't want to hear about the producer price index, the FOMC meeting in minutes, or some speech in the mountains of Wyoming. It's not as exciting as a meme coin mooning 1,000% overnight or some influencer screaming the next bull run is confirmed on Twitter. But here's the reality. This is the boring stuff that drives the market. So pay attention. As you heard Sandy Call mention, now is the time to educate yourself. And this is the stuff, in our firm opinion here at CYPRX, that people should be educating themselves on, because this is exactly what is keeping our community ahead of the retail crowd and allows us to position ourselves in these dip buying opportunities with accuracy and precision, right? Just like Eric Trump said, buy the dips. Most people don't even know when the dips take place, why they happen, or what's going on, and if they should even buy them because they get too fearful thinking that the market's going to completely correct or turn into some bear market cycle or whatever. Again, block out the noise and understand the markets in which you operate in. So, last week's reality check. From Wednesday's peak near $4.19 trillion, the total cryptocurrency market shed over $260 billion. But why? This is because of three letters that most retail traders gloss over, and that is the PPI, the Producer Price Index. And that jumped 0.9% month over month in July from the expected reading of 0.2%, the biggest sleep in over 3 years. On a yearly basis, prices also climbed 3.3%, the highest since February. Core PPI, which strips out food and energy, surged just as much. The translation in all this is that inflationary pressures are not going away quietly. 2 days before that, the CPI report last week had everyone euphoric about September rate cuts. But Thursday, the PPI data had killed off any talk of a jumbo 50 basis point cut and even introduced whispers of the Fed holding rates steady at their next meeting. If you were paying attention, this was not a surprise. We flagged this in our August 6th private community Zoom call in the CYPRX Discord. So while retail was busy chasing pumps last week, $260 billion quietly vanished from the market, which offered some really good entry discounted opportunities. Another thing most retail traders scroll past is geopolitics. Last week's Trump and Putin summit in Alaska grabbed headlines, but most dismissed it as political theater. The reality was that Trump's tone shifted dramatically in less than 24 hours from pressing Putin on a ceasefire to pushing for a direct peace deal. Meanwhile, Ukraine and its allies are warning that Russia is massing 110,000 troops for new offenses. So everybody was getting euphoric that this was going to bring some sustainable rally in crypto, but in reality, the fighting is still happening. Why does this matter to the markets? Because geopolitics is where tail risks still live. A sudden headline about escalations or any expected peace breakthroughs can yank risk assets violently in either direction. So you can choose to ignore that at your own risks, but it would behoove you guys to pay attention to those types of details. Now, the week ahead, all eyes are going to be on the Jackson Hole Summit. Here's where the boring stuff really starts to matter. On Tuesday, we have U.S. housing starts and building permits in the United States. On Wednesday, we have the FOMC meeting and minutes release, and we have multiple Fed governors speaking like Fed Waller and Fed Bostic. On Thursday, we have the Philly Fed Index, jobless claims, PMI, and home sales. And on Friday, we have Jerome Powell speaking at Jackson Hole. And if you don't know how to track any of these things, then come tap in with the community that does, where all throughout the week, we host 5 to 7 Zoom calls breaking all of these things down, going over fundamentals in detail, and talking about the risk sentiment intraday, day by day, week by week, to keep us in the loop with what is happening in this ever-evolving space. It sounds dry, right? Yet this is where risk sentiment for the rest of August gets shaped. Markets are already pricing in a 90% plus probability of a September cut. What Powell says or doesn't say at Jackson Hole will likely determine whether we rally, chop sideways, or correct deeper. A lot of people don't talk about Japan, but that's something that we fixate our attention on in the private CYPRX community. The Bank of Japan is another boring one. The yen last week just hit a 3-week high on expectations that the Bank of Japan could hike before year end, a total divergence from the Fed's likely easing path. Japan's economy is quietly expanding. Corporate investment is up 5.5%, exports are up 8.4%, and inflation is still sticking. That's why the Japanese yen strength is creeping into markets, fueling some of the risk off flows that we saw this past week. Next week's Japan inflation data could stir things again, so pay attention to detail as we have the national core CPI on Thursday/Friday. It'll be Thursday here in the United States, but Friday morning for those Asia session traders. So why does all this matter? Let's wrap this up. Markets are headline driven right now, not crypto headlines, not influencer hype, real headlines, Fed policy, inflationary metrics, labor market data, tariff headlines, geopolitical tensions, and central bank positioning. All of these things are the things that you all should be mindful of. Yet again, most people ignore because they're boring and they're not hype driven. If this upcoming week we see a dovish Powell, risk assets could rally and crypto could breathe a sigh of relief. On the flip side, if we got a more hawkish leaning Powell, hinting at a higher for longer interest rate environment, this could weigh further on the market sentiment. If we see Japanese data come out this week, hinting at a possible Bank of Japan rate hike, the Japanese yen could strengthen, and this could drain risk appetite globally. And if we see any uncertain or negative geopolitical or tariff headlines, tail risks could spike and safe haven demand could catch a bid. So you can decide to ignore all these factors, but smart money won't.
All of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster.
The boring stuff like inflation prints, central bank speeches, PMI surveys, and geopolitical summits this upcoming week are exactly what will determine what the next move in crypto is, up or down. Retail loves chasing shiny headlines. However, smart money is already gaming out what Powell will say at the Jackson Hole. If you want to stay ahead in these markets, it would behoove you all to pay attention to what most people scroll past, because in this environment, it is the boring stuff that makes or breaks the rally. So that is my spiel here for the second portion of today's video breakdown. Now is the time to be learning about these new technologies in detail, but not just learning about these new technologies, learning about key driving factors that sway market volatility within these new technological advancements. As always, bringing you guys some of the realest information and research in the game. If you guys enjoyed today's video breakdown, do me a favor, smash that thumbs up button and subscribe. Don't forget to go back and watch part 1 of today's video breakdown. And with all of that in mind, none of this is financial advice. Always be cognizant out there, be aware, and I will see you guys in the next video breakdown.